that now unlisted shares and listed shares are being taxed at parity. You know, for unlisted, it's 2 years is the holding period. For listed, 1 year is the holding period. But capital gains tax is 12.5% on both.
Correct, of course it is. I think before we get to that topic also, on real estate, there's one fine print which I think most of the tax guys should actually read out, is there used to be a fair market valuation concept of 1st April 2001. If that still remains, because taking away indexation so retrospectively doesn't make sense, because the indexation year was changed, I think about 6 years back, from 1981 to 2001.
Right.
So you were allowed to create a fair market value of your property and then pay tax with indexation.
So reset your old property value to 2001. And then calculate
do the
indexation.
Now, if you've removed the indexation, are you saying you're doing it so retrospectively that it's 50 years? You can take away the indexation benefit of 24 years of this century. If that's the case, then most of the ancestral property is safe in terms of tax.
But, you know, just to go back now and how we need to look at our overall portfolio, considering there's a lot of tax change, Feroze. So what are your hygiene steps? What would you advise people to do immediately?
See, firstly, equity investors should be happy because savings go into one of these assets. Okay, if only equity taxation was tampered with, I would be very clear that the market reaction would be very negative. Because you can't use up the money just because taxations have changed, right? You're going to be either your real estate taxation has gone worse off, your several other taxations, indexation is gone. Section 48 is irrelevant today, right? Where it was only exempt for bonds and debentures. Now, nowhere there is indexation. So relatively, you're better off with just a 2.5%. If anybody would have voted for an increase in long-term capital gains, nobody would have guessed such a small number. And this could have been done in isolation, keeping all assets equal. But that has not been done. The detriment to the rest of them is substantive. And the advantage to a mutual fund platform and equity is, of course, relatively there is an advantage. In an absolute term, there is a loss. That's point one. Point two, I personally think if you look at what portfolio changes you will have to make, I think sovereign gold bonds attractiveness comes down dramatically because the relative differential taxation from a gold fund to sovereign gold bond now becomes 12.5% because sovereign gold bonds were taxed, is the only instrument which is still left. ULIPs have also come into the tax net, right? So that's the point too. So I think there is not too much asset allocation change you will have to do. Your attractiveness of sovereign gold bond has come down. But I personally think that the biggest risk was the broader market selling off. But the broader market should hold up with a taxation change like this, because the biggest risk was the differential performance of the broader market, small and mid cap, over the last year and a quarter, with Nifty of about 35–40%. If there was a worse off news, then this additional alpha which the broader market got would have compressed significantly, if not the headline.
So let's say if we've indeed digested the bulk of it and whether, you know, we can go back to business as usual.